Let's take a look at the accounting for bonds payable from the corporation's viewpoint, and let's take a look first of all at the most simple situation where bonds would be issued at their face value. So in this example we'll have the corporation issuing bonds with a face value of $200,000. That face value is printed on the face of the bond along with any promise to pay interest. This bond is promising to pay interest at a stated rate of 5%. Again, that's stated right on the face of the bond. In order to simplify things, we're going to keep the maturity period for this bond short, 5 years, and instead of the more usual semi-annual interest, we'll just do our computations using annual interest. That way we can see the progression of the entire life of the bond, what the accounting would look like. When the corporation actually issues those bonds, as long as the market rate of interest is the same as this stated rate, 5%, these bonds would be issued at face value. In other words, bondholders would be happy to pay $200,000 for these bonds. The corporation would record it like this. They have an inflow of cash. Cash goes up $200,000 at the issuance, and of course they now have a liability, a long-term liability, bonds payable, equal to the $200,000. This $200,000 needs to be repaid at the end of 5 years. But remember, in the meanwhile, the corporation also has to pay interest. Well, how much interest does the corporation have to pay? It will always be the stated rate times the face value of the bond, the two things actually printed on the front of that bond. So annually the corporation is going to be paying $10,000 worth of interest. At the end of year 1, cash goes down $10,000. They're writing out checks, sending them to bondholders, and the corporation records $10,000 of interest expense. Same thing happens in each of the 5 years. Then, at maturity, the corporation also has to pay back the principal, or the face amount of the debt, $200,000. So cash goes down $200,000, the liability is paid off, bonds payable also goes down by $200,000. You can clearly see here that there's two different cash flow streams: the annuity amount of the interest payment and the lump sum payment of the face amount due at the end. Now let's take the same basic example and complicate the situation a little bit by making it more realistic. We'll have this bond being issued or sold at a point in time where the market rate of interest will not exactly equal the stated rate of interest, and in that case issuance of this bond will result in either a premium or a discount, and the accounting is complicated by how we deal with that extra amount that the corporation gets in advance, or with the amount that the corporation doesn't get from the bondholders that it eventually has to pay them back. The underlying accounting, though, is still as simple as this. The corporation has borrowed money, they're going to pay it back, and in the meanwhile, they're making interest payments. Well, first of all, let's consider a discount situation. A bond is issued at a discount when the issue price is less than the face value of the bond. So we know in advance, since this is labeled discount example, that this bond is going to be issued for something less than $200,000. Why would that be the case? Well, a bond is issued at a discount anytime the stated rate of interest is less than the effective rate or the market rate of interest. So in this first example, we're going to assume that the market rate of interest is 6%. Because the stated rate of interest is too low, it will force the issue price of the bond down to something below $200,000. What will this bond sell for? Well, we have all of the information here to figure that out. Remember, it's just a time value of money computation. Let's take a look at how we do the math. First of all, remember there's two components to this computation. The corporation is going to pay $200,000, but it doesn't have to pay it for 5 years. So what's the present value of that $200,000 today? Well, to determine that, you would multiply the $200,000 by the factor for a single sum, so just the present value factor, the one lump sum payment table, for 5 years, and this is the key. You need to discount that payment back to today using the market rate of interest, so 6%. The factor from the table for 5 years, 6% is right here, 0.74726. Multiply that times the face value of the bond, and that gives us half of our issue price computation. The other half of the issue price computation has to do with the annuity payment. Remember that the corporation also has to pay annual interest. Well, what's the amount of the annual interest? This is the same example we had before. So once again, it's the stated rate of interest, 5%, times face value of the bond, or $10,000 each year for 5 years. So we want to know what's that worth today. Well, we multiply the annuity amount, 10,000, times the present value of an annuity factor for 5 years, and again, make sure you're using the market rate of interest there, 6%. Here's our factor. Do the math, add up both components of the cash flows of this bond, and we get a number similar to what we would have expected, something less than 200,000, 191,576. This is the amount that bond would sell for. The issue price of the bond is also the initial carrying value of the bond. It's what we're going to carry that bond on our books at. At the maturity date, the carrying value of the bond must be equal to the face value of the bond. So this carrying value is going to get bigger and bigger over time until it reaches $200,000. Carrying value of a bond will always equal the face value of the bond at the maturity date. Well, what else do we know about this bond? We know that the corporation is going to be making, as in our previous example, the cash payment doesn't change. So as before, the corporation is going to be making 5 equal interest payments of $10,000 each. So we know our payment is based on the stated interest rate times the carrying value of the bond, and that's known in advance no matter what the bond is issued for. The difference here is that interest expense will not equal the cash interest paid to the bondholder, because part of this computation will be the amortization of a discount or a premium. So the difference between interest expense and interest paid will end up being the adjustment to the carrying value of the bond. It'll be the amount that this carrying value grows by over time. What we're demonstrating here is a method called the effective interest rate method of amortizing a bond discount or premium. In this case, we're amortizing a discount. The second step in this amortization process is to compute the amount of interest expense. Interest expense is always computed as market or effective interest rate, in this case 6%, times current carrying value of the bond. Well, for this first payment, the carrying value of the bond was $191,576. So if you take 0.06 times $191,576, that gives you your interest expense of $11,495. The difference between cash paid for interest and interest recorded as expense is what I'll call here amortization of the discount. Amortization is the amount by which the carrying value of the bond changes. So in this case, remember, we knew the carrying value has to get bigger, so the new carrying value of the bond is going to be $191,576 plus $1,495. It grows to $193,070. So I'm here in an Excel table. These are all formulas. So it's very simple to copy that on down. Notice that interest expense changes each year. In year 2, interest expense is 6% of my new larger carrying value of $193,070. Interest expense gets larger every year because the carrying value of the bond has gotten larger every year. Also notice, as predicted, the carrying value of the bond has grown to $200,000 over its maturity period. The original amount of our discount, the difference between the face value and the issue price, was $8,424. It's $425 here because of some rounding, but it's the difference between $200,000 and $191,576. The amortization of the discount is the difference between the interest paid and the interest expense recognized by the corporation. Amortization of a discount increases interest expense over the amount paid. In fact, we can predict total interest expense related to a bond. We can always predict it by just computing, and this is usually a fairly simple computation, total interest paid on a bond plus any discount. Because remember, the discount is the amount of cash that the corporation did not get up front that it's going to end up paying to the bondholders at the maturity date. So it makes sense that that's just additional interest expense. Alright, well, this is the amortization schedule for the bond. The amortization schedule can be prepared at the date the bond is issued. Businesses will show the bond on their balance sheet at its carrying value, which will be determined by this schedule, unless they've elected to report the bond instead using fair value. That will be discussed separately. If the corporation is not using fair value, then again, this determines the balance sheet valuation for the bond at the end of each balance sheet date. Let's take a look at the underlying transaction analysis for the bond. At the issue date, corporation is only getting $191,576 of cash. Remember, they're not getting the full $200,000 because this bond was issued at a discount. Bond payable goes up by the same amount. We need our amortization schedule as prepared at the inception of the bond using the market rate of interest in effect when the bond was issued. We use that information from that amortization schedule to do the accounting over the life of the bond. The first cash interest payment is, as you recall, $10,000. We record $11,495 as interest expense, and that comes straight from the interest expense column of that amortization table. The balance in the bond payable account goes up by the difference, $14.95. That's our amortization of the discount, increasing the carrying value of the bond. For the next 4 payments, we do the same thing. At the end of each year, we go back to that original amortization schedule and do our accounting for the bond. At the end of the life of the bond, notice that we've paid a total of, we've recorded a total of $58,425 worth of interest. In addition, at maturity, the bond payable account has grown to, with all of these adjustments, has grown to $200,000. This is the same entry we made before to pay off the bond at maturity. Notice that the corporation paid out a total of $250,000 when it only received $191,576 upfront from the bondholders. The difference between the $250,000 and the $191,576 turns out to be the total interest expense that the corporation pays. We need the amortization schedule so that we know which year to record how much interest expense in properly. Alright, well, let's take a look at a slightly different approach to actually doing transaction analysis and doing the underlying bookkeeping for this bond. Instead of recording the bond and putting the issue price of the bond in the bond payable account as the original amount, what's often done is 2 accounts are used instead. If a bond is issued at a discount, you put the face value of the bond payable in the bond payable account, and you create a separate contra liability account called something like discount on bonds payable. And this account, the discount account, basically gets amortized and becomes 0 over time. So the rest of the accounting looks very similar to what we saw before. When the corporation pays $10,000 in interest, they record interest expense of $11,495, and the bond discount account gets credited by $14.95, and eventually the bond discount account becomes 0. At the maturity date, since the discount account has been amortized away to 0, the only thing left is the $200,000 in the bond account. So, of course, that entry looks the same as what we saw earlier. Cash goes down $200,000, bond payable account goes down $200,000. For this class, let's just use this first method I showed you for transaction analysis. It is a little bit more straightforward, I think, a little bit more intuitive to see the carrying value of the bonds grow over time. So we'll use this approach in any of our discussions. Let's do another example together, and this time we'll set up the situation such that we can look at the accounting for a bond that's been issued at a premium. Before we look at the math, let's quickly review some of the notes that I have on the handouts for bonds. I didn't review these notes in the discount situation, so we'll review them here. Please read through these things on the other side for when a bond has been issued at a discount. So in a premium situation, a bond will sell at a premium when the stated rate of interest is higher than the market rate. You compute the issue price, as always, by determining the present value of the cash flows using the market rate of interest. So it's the market rate of interest that you use when you go to your factor tables. The initial carrying value of the bond will always be equal to the issue price of the bond. At maturity date, the carrying value will be equal to the face value of the bond. So in the case of a bond issued at a premium, the issue price is going to be higher than face, and the carrying value will have to drop over time such that it will be the face value by the maturity date. So it's going to be the opposite pattern that we saw when bonds were issued at a discount. Same rule, just the opposite pattern. And as we saw before, the actual interest, the cash payments of interest that are made to the bondholders are based on the promise that's printed on the bond, so they're always stated rate of interest times face value of the bond, whereas the interest expense being recorded by the corporation using an effective rate of interest method is always the market rate of issue determined by the market price at the issue date times the current carrying value of the bond, and we know that that carrying value changes over time. And finally, in the case of a bond that was issued at a premium, we'll note that total interest expense over the life of the bond is going to be the cash paid for interest minus the original premium amount. And that makes sense because the original premium amount is the amount of cash that the corporation got from the bondholders that it doesn't have to pay them back. It simply pays them back the face value of the bond, so that extra cash it got is like a refund of interest. It's negative interest expense. So again, same rules we saw for bonds issued at a discount, but everything's slightly turned around because now we're in a premium situation instead of a discount situation. Let's take a look at some numbers. Okay, what I've done here is I've kept the same market rate of interest that we had in the discount example. So my time value of money factors will be the same as you saw in the discount example. But what I'm assuming is different is the interest rate that was printed on the bond. This time around, the bond is promising to pay an 8% interest rate. That's higher than the market rate. So we know in this case this bond will be issued for something greater than face value. Once again, we can determine exactly the amount of the issue price by doing a time value of money computation. The face value of the bond will be paid to the bondholders at the end of 5 years, so multiply it by a present value factor for 5 years and the market rate of interest, 6%. The annuity payment is different because I changed the stated rate on this bond. So what's the amount of the cash paid to the bondholders? Well, as we said, it's always stated rate of interest times face value of the bond. So corporation this time around is going to make 5 $16,000 interest payments. The value of those 5 payments today would be $67,398. We multiply 16,000 times the annuity factor for 5 years, 6% interest rate. When we add up the present value of both cash flow streams from this bond, we get $216,850. That is the selling price of the bond and the initial carrying value of the bond. The amortization of the bond works just like the discount situation. The interest payment is known in advance. That's our $16,000 every year for 5 years. Interest expense is the same formula as before. It's the market rate of interest, 6%, times the current carrying value of the bond, which for this first period is $216,850. So $216,850 times 6% gives us the $13,011. Amortization is just the difference between amount paid and interest expense recorded. It doesn't really matter whether you have brackets around it or not. What you know is this is the amount by which your carrying value has to change. You stop and ask yourself, should my carrying value be getting larger or smaller? Well, it started out at $216,850, the issue price. We know it has to be $200,000 by the end of 5 years, so when a bond is issued at a premium, the carrying value gets smaller each year. So in this case, carrying value is last carrying value less the amount of amortization. So carrying value is $216,850 minus $2,989 or $213,861. To get interest expense in year 2, you multiply the $213,861 times the market rate of interest of 6%, and that gives us our interest expense for year 2 of $12,832. As before, we note that the interest expense is changing all of the time because the carrying value is changing all of the time. Notice what happens over the life of the bond. We do, as hoped, amortize the carrying value to $200,000. Cash paid to bondholders for interest is $80,000. But the only amount of interest expense recognized by the corporation is $63,151. It's the amount of cash paid less that premium amount of $16,849, which is the extra amount of cash that the corporation got from the bondholders up front that it doesn't have to pay them back at the end. So that extra $16,850 of cash is basically negative interest expense. And here's our transaction analysis for the bond, summarized over the life of the bond. At the issue date, the corporation receives $216,850 from the bondholders. It has to pay them back, so it records the long-term liability, a bond payable of $216,850. At each interest payment date, the corporation is going to reduce cash by the amount of cash paid to the bondholders, here $16,000. They're going to record the amount of interest expense that shows up on the amortization schedule that we just built together, and they'll adjust the carrying value of the bond account by the difference. Notice in this case, the bond payable account is getting smaller all of the time. It will get down to $200,000 at the maturity date. And at maturity, cash goes down $200,000, the bond payable account goes down $200,000, and everything for this bond has been accounted for. One last thing, realize that this accounting for the bond assumes that the corporation has not elected to account for the bond using fair values. This example assumes instead that the corporation is using amortized cost to account for its bonds.